13F filings have come out, and here are the 5 stocks that our friend, super investor Warren Buffett, is buying. Stock number 1, Occidental Petroleum. Guys, Warren Buffett has been buying this like crazy. He owns like 30% through Berkshire Hathaway of this company. Now, guys, here's the interesting part. You look at the 5-year on Occidental, you're at 37% growth. That's not a ton over the last 5 years. The market has absolutely crushed that. But Warren Buffett loves this company, even though, look at this return on invested capital. Very low. Very, very low. So right now, Warren Buffett right here, 255 million shares, current value of $14.6 billion. Guys, these are all these purchases along the way. What's interesting is they show 19 million shares sold back in early 2020 at roughly $20 a share, but then they started buying more as time went on. Now, guys, you hear me in my videos. I always say, don't buy a stock because somebody on the internet does or somebody you respect does. I look at Occidental. I've never bought a share of them, even though Warren Buffett's buying a ton. And here's why. I'm baffled as to why he has it. I look at this low return on invested capital. He's so big at talking about returns on invested capital. I look at this saying, now they pay 2.5% dividend. They are selling for a cheap multiple of free cash flow, because the one thing I do like is their 5-year average free cash flow is way better than their 5-year net income. But I look at other things. I look at this 8 pillars. Not to say 8 pillars determines if I'm going to buy or sell a stock, but what here is something fun to like. I do like the fact that the 5-year PE is significantly higher than the price of free cash flow, but debt, low return on invested capital. Why is that exciting to me? Why is that exciting to me? I don't know. Income statement. A lot of volatility in this price of revenue. Why? I'm sure that this company, like other commodities-based businesses, are going to go up and down based on where the underlying commodity goes in price. He sees something there that he loves, more power to him. But for me, I look at this saying, I don't necessarily get it, and I don't understand commodities, and I want you to learn that. Here's the best investor of all time buying a ton of this company, and I'm like, I don't get it, so I'm not going to buy it. That's okay. You need to be confident enough to say that, because if the stock fell in half tomorrow, I'd have no idea why it fell in half or if I should buy more. Warren Buffett does. That's why he should stick with it. Stock number 2, HEI. HEICO Corp. It's an aerospace and defense contractor. So let's pull up Warren Buffett's current position. Very small position, 1.04 million shares, current value of 188 million, and he just recently purchased that. So this company has gone up a ton since 2020. Look at this. What was it at? Roughly 55, 60 bucks a share. And now he's been buying it at $188 a share, $170 a share. Okay. He has 1 million shares outstanding. Let's sit here and look at 8 pillars. Look at this, guys. 5 X's, 3 checks. A lot of debt, low ROI. I'm actually surprised by this also. High 5-year PE. Man, it's kind of surprising to me. So guys, somebody in his company clearly likes this. Now, I will say, I think there's a lot more buying and purchasing done based on technical analysis at Berkshire Hathaway than people want to admit. This is purely speculation. But I see them getting in and out of companies all the time. I wonder to myself, why do they do that? And they buy companies like Amazon sometimes and they get out of it. I look at this company going, where is the attractiveness here for this company? Where is the appeal? A low return on invested capital with a lot of debt? With a high margin? With high multiples? I don't really follow this very well. There's nothing here that appeals to me or would appeal to what I consider to be a value investor. Now, the great thing about Warren Buffett is he likes to give his soldiers, the guys who manage money for him, full autonomy. He does not get involved with them. He might make a comment, but he lets them handle the money the way they want to. Let's see what the analyst estimates are for this company going forward. See, yeah, it's a lot of EPS growth, 356 to 637, but it takes 70x free cash flow down to 35, not even, down to like 40. And it still takes 4 years to do that. I'm perplexed. I don't get this. This one owns my brain. Not going to lie to you. Now, stock number 3, ULTA Beauty. Now, guys, this is a company I do understand better. I have position in ULTA. Again, I don't know if Warren Buffett bought it or just somebody at Berkshire Hathaway. But again, don't buy any stock because anybody on the internet does. I like ULTA for many reasons. One, they have same-store sales growth. They're not growing just to grow. They're after the women market, which is a great market to sell to. Women still like to shop. They're going into Targets, another place that women love. They're being smart and strategic about their growth. That's what I like about them. And I think they're selling for a pretty reasonable valuation with such a high return on invested capital? This one makes more sense to me. High return on invested capital might be a frothy price of free cash flow 20, but it makes more sense to me. Now, this company was as low as 320 just recently, so these multiples were even better. Analyst estimates, look at this growth. Apart from next year, double-digit growth on earnings per share from $26 to $41 a share, and revenue growth, mid to high single digits. I like this. I like this a lot. Now, this is a company, if you look, had an all-time high of 575 back on March 14th of this year. Fell as low as 318 just last week, 2 weeks ago. 2 weeks ago, 318 from 575 5 months before. That shows you the volatility. That shows you what can happen. Remember, it's important to understand that what we're trying to do here is to shift everybody's thinking. We want to shift you from thinking about a stock price going up and down to buying a company, buying a stock because it's a piece of a company. We made these tools. We have this community for that exact reason. Now, guys, you may have noticed if you go to everythingmoney.com that we are limiting the number of daily spots for our software and community. And for the reason for that is the software that exists today includes everything that we've always made having to do with retirement, stocks, and real estate. But we now have 4 YouTube channels. And behind the scenes, we're making some big changes as we continue to expand and grow so tremendously. These offers are going to be separated, and the current offer of everything is going away very soon. You may remember, if you've been watching us for a while, and we have a lot of people who have been watching us from the beginning, that I built this software selfishly for myself so that my team and I could use it to make better decisions. But guess what happened? People out there watching our videos said, hey, how do I get that software? So we said, let's make the software for everybody. The channel's grown, the community has grown, and it's becoming less about me and more about how I can make the software better to serve you and the community members. Now, the good news is these changes haven't been made yet. So if you join today, you'll be grandfathered in for life to get all of these, and any tool we make in the future will be included, and you'll be locked in at your price level forever. You're going to get all of this and keep that price level. This is the best deal we've ever offered. So if you want to make better returns, if you're serious about making better financial decisions, and even more important, if you want to sleep better at night, click on the link in the description below, everythingmoney.com/sign up to go sign up. 7 days for $7. Try out the software. You have nothing to lose. And I'm very confident it'll be the best decision you've made all year. So guys, what's the right price to pay for ULTA? Well, guys, here's what I did in my 10-year analysis on our stock analyzer tool. I did 3, 5, and 7% revenue growth. I think that's pretty reasonable. Look at their history. 10 years, 15% revenue growth, but I don't think they're going to match that over the next 10 years. Profit margin, 9.5, 10 and a quarter, 11. Same with free cash flow. And because of the high because of the high return on invested capital that's growing, usually I'd go higher than this on PE, but it's still retail, so I want to be a little more cautious. I put 15, 18, and 21. Now, what you could do, since the ROIC is so high, is put a higher PE in and put in a bigger desired annual return. I put in 9%. This is for basically my intrinsic value because the market does 9 or 10% return. But remember, you need to put a margin of safety in there. This is just to tell me, Paul, based on your assumptions, this is about what the stock is worth. The stock's currently at 378. I have a low price of 341, high price of 660, middle price of 476. So even at today's current price, if my middle assumptions occur, I might be able to get about a 12% return on my money. So you saw how attractive it was at 320. Stock number 4, Sirius XM. Guys, here's some interesting stuff. First off, they own 133 million shares, total value of 425. Remember, guys, this is a company with $270 billion, not the company, Berkshire Hathaway, $270 billion in cash. This is nothing for them. This is literally nothing for them. That $270 billion in cash, just in 90-day treasuries, generates, what, $14 billion a year? It eats up 1 week of that money that they earn on that. I mean, it's very, very little. Here's what's interesting. They had 2 purchases before, and they sold a bunch of shares. This is where the company spiked, probably when Berkshire Hathaway bought. They bought 10 million, bought 31, then sold 4 million. This is what confuses me about Berkshire Hathaway. This is why you need to make independent decisions. Why would they do this? Why sell 4 million shares when they had 41 along the way? And not just if they need it, because somebody said to me, well, Paul, they want to buy something else. They have $200 and some billion in cash in early 2024. Why do you need to sell shares? And they went and bought 96 million shares. But this makes sense because the stock fell tremendously. Okay, makes more sense. But SiriusXM, let's go look at the company. $12 billion market cap, $25 billion enterprise value. That difference here, that $13 billion is essentially debt. Now here's what's interesting. Their free cash flow is only $1.2 billion a year. Their 5-year average is 1.5. So they're declining their free cash flow. The cash flow is decreasing. They have two X's, debt and free cash flow growth. Now here's what's good though. Return on invested capital, very high. But I just don't get this. Dividend yield 3%. I don't understand. I mean, I just really do get confused by some of these moves. 52-week low. Look at this. Back in June, $2.45. 52-week high, $5.78. So let's see what they were doing back in June. Man, 2024. Yeah, they were buying some. They were buying. That's good. They were definitely buying. That's pretty good of them to do that. But it's only at $3.14 a share right now. Sirius has a great business. The question is Sirius the new radio? Let's see what analysts are saying about Sirius. I mean, there's not much revenue, earnings per share growth here. But at 40 cents here, if you're buying it for $3, you're looking at 7.5 times 4 years from now PE and 10 times today's PE, 9 to 10 times. Okay. Makes sense. High return on invested capital. Can they generate the cash flow? I mean, $1.5 billion in free cash in the last 5 years. Last year, $1.2 billion. That's 10 times price of free cash flow. Okay, makes sense. I can get that. I can understand that to a certain element with a high return on invested capital. Stock number 5, Chubb Insurance, CB. Guys, Berkshire Hathaway is an expert in insurance. This is a company where if I were to copy anybody in insurance, it would be Berkshire Hathaway. So guys, they currently own 27 million shares, $7.5 billion in value. That's a big one. And you look at the stock, it was at $100 a share back after COVID, and it's currently at $250 a share, and they've been buying all along since $200. So they understand insurance. That was their business. If you don't know this about Berkshire Hathaway, Warren Buffett and Berkshire have gotten about 20% returns annualized after taxes since they opened their partnership in 1965. But a lot of that is actually using leverage. What they do is they use the float from insurance companies. What that means is when you pay insurance premium, the insurance company who charged you that money expects to pay 100% of that money out in the future, 100% of it. But their goal is to use that money in that time period to go make money, make investments, and make the spread. That's what Warren Buffett and Berkshire Hathaway have done. So they've essentially borrowed money for free in order to make investments. Some people estimate that's increased their returns from 14 or 15% up to 20%. Now, insurance companies are analyzed a little bit different than other companies. It's not just like the understanding the financials of insurance companies is important. That's why I look at Warren Buffett and their company. That's the fundamental part of their company. I have a hard time believing that insurance is going away. At the end of the day, insurance is just hedging yourself. We're always going to have people hedging, and companies require this. They're required to have insurance for your home, for your car, things like that. Insurance is not going away. There's still going to be useless lawsuits. People are going to have to hedge against that. So insurance is going to be around for a long time. And Berkshire Hathaway does a great job of understanding and buying the right insurance companies. So guys, with all 5 of these picks, I'm all across the board on these. Again, who am I to say Warren Buffett's right or wrong? And we don't know which companies Warren Buffett was personally involved with buying. My guess is Occidental and Chubb. And the other 3 were his people beneath them. So if you want to see our other super investors video, watch our next video. Thank you very much for your time.